Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The most impressive magic trick in the modern workplace is the ability to stretch a 10-minute update into a 45-minute meeting. Political campaigns are the only job interviews where you can actively insult the previous employee, present zero verifiable skills, and still get hired by the shareholders. Never trust a person who says they sleep like a baby. Babies wake up screaming every 2 hours and soil themselves. I tried being myself at full capacity. Turns out, it's a beta version. The future used to be exciting. Now it just sends calendar invites.
Anthropic is scaling up like a startup on Espresso. Usage jumping fast, closing the gap with OpenAI in at least enterprise adoption. This isn't just hype. Companies are multi-homing AI, testing, switching, optimizing. Loyalty is low, performance is everything. OpenAI still leads, but Anthropic's rise shows this market isn't winner takes all. Yet. And the real story, any AI is exploding, meaning adoption is outrunning the rivalry. Zoom out a decade and one thing's very clear. Cyclicals had the last laugh. Metals lead the pack, but real estate and energy are not far behind, riding the capex and commodity waves. But 2026, different mood. Weakness is broad, leadership is missing, and even yesterday's winners look a bit tired. That's the nature of markets. Sectors don't retire at the top, they rotate out quietly. So the story isn't just who won the decade, it's who's next when the cycle returns again. After years of a stampede, Demat growth just exhaled. FY26 saw the slowest additions in years, even as IPOs were flying off the shelves. That tells you something. The easy retail money is already in. The frenzy phase is cooling, and new entrants aren't chasing every listing anymore. Markets aren't losing interest, they're just getting selective. Fewer first-timers, more seasoned players. Which ironically is how bull markets grow up. Like Benjamin Graham said, the investor's chief problem, and even his worst enemy, is likely to be himself. From steady to surreal, AI funding just hit $242 billion in one quarter. That's not growth, that's a vertical takeoff. This isn't broad-based either. Capital is piling into few giants and must-win infrastructure bets, compute, models, chips. It is less spray and pray and more pick up the future and overfund it. The signal, investors aren't asking if AI wins. They're arguing over who captures the upside. But when money moves this fast, expectations tend to outrun reality, at least for a while. One soft month, $10.3 billion in February, but zoom out and US-India trade is still up 12% year on year. That's not a slowdown, that's a breather. Monthly data can wobble, inventory cycles, timing, and even shipping quirks. But the broader story is intact. Supply chains are slowly moving towards or tilting towards India. Exports are steady, imports are climbing, and the corridor keeps deepening despite global noise. Short-term dip, long-term drift higher. That's a real signal here. That 13.5% deposit growth looks tidy, but timing is doing some heavy lifting. Banks tend to window dress balances at March end, pulling in deposits that quietly slip out in early April. So comparing April 2025 to March 2026, you're mixing a normal day with a dressed up one. The bigger picture hasn't really changed much. Deposit growth is decent, but still chasing credit growth. Liquidity isn't tight, but it's not exactly abundant either. In other words, the headline looks better than the underlying trend.